Hello and welcome to the Trade on the Market, where we provide you with insight and education on the latest economic development and market trends. My name is Thomas, and in this video I will cover the most important macroeconomic data releases for the week ahead and explain their potential impact on the financial market. Moreover, we're going to talk about a little bit on the Chinese data as well, because China is just reopened and we need to know whether it's good or bad for us. So whether you're a beginner or an experienced trader, this video is for you. So sit back, relax, and let's dive into the world of macroeconomics and trading. We're going to start with the Monday's most important data, which is going to be released at 11 a.m. Central European Time. And this is the EU retail sales macro data, which is important for investors because it measures the total sales of retail stores in a country, economic region, or in our case, the European Union. It gives insight into how much consumers are spending. This information can help investors understand how optimistic consumers are about the economy and whether companies operating in the retail and consumer sectors are likely to see higher profits. So, retail sales macro data is an important economic and consumer confidence indicator that provides valuable insight to investors. It's not surprising that the previous minus 2.7% figure is not good news. However, if we look at the trends since 2020, we've seen negative values quite frequently. On one hand, this is a bad news because the retail sector of the economy is not performing well. But on the other hand, it's good news in that this negative data does not contribute to inflation, which is the most important consideration for the European Central Bank at the moment. We should not be surprised by the further negative data, as intentionally suppressing demand is practically expected. However, it's important to know that this is not good for the region's currency, while an exponentially positive value could potentially create volatility around the euro. So this is the one which is the most important on Monday, and let's talk about Tuesday. The first we need to have a look is the Australian cash rate, which is the interest rate at which the Australian Reserve Bank, RBA, lends or borrows money from commercial banks. The RBA determines this rate, which is reviewed and set on the first Tuesday of every month. The Australian cash rate is important to investors and traders because it can significantly impact the country's economy and financial markets. Changes in the cash rate can affect the borrowing costs of consumers and businesses, which in turn can influence spending and investment decisions. Furthermore, the Australian cash rate can also affect the country's currency, the Australian dollar. When the cash rate increases, it can make the Australian dollar more attractive to investors seeking higher returns, leading to increased demand for the currency and potentially appreciating its value. On the other hand, if the cash rate decreases, it can make the Australian dollar less attractive to investors, leading to decreased demand, depreciating its value. If the Australian cash rate aggressively rises, it may indicate that the RBA is concerned about the inflation and is attempting to slow down the economy. This can lead to a decrease in consumer and business spending, negatively impacting the economy and financial markets. Conversely, if the cash rate decreases, it may indicate that the RBA is attempting to stimulate the economy, encourage borrowing and spending, and have a positive impact on the economy and financial markets. Considering these factors, it is evident that the RBA is currently in a tense situation regarding inflation, but there has been a slight slowdown in cash rate growth over the last 4 months. These are cautious moves by the central bank, but it is clear that they have not yet ceased. While it may not have much of an effect against the US dollar, further expected rate hikes could lead to a consolidation in the Australian dollar index. This is a significant event for the Australian dollar, and it is worth using analytical skills in the forex market. The second very important thing we need to talk about Tuesday is that at 4 p.m. Jeremy Powell, the chairman of the Federal Reserve, will give a speech. This speech is particularly important because we want to find out what he thinks about the looming threat of inflation. We also want to know how he will respond to the previous statement of other Fed members. Additionally, we want to figure out what he is leaning towards right now. Is it a 25 basis points increase or 50 basis points increase? You might think that the answer is simple. We need a 50-point increase because things are looking bad. The CPI might turn, unemployment is rising, and the situation is worrying. However, we must not forget that Powell has committed to the previous 25-point increase, which is proving to be increasingly inaccurate. Acknowledging this by implementing the 50-point increase could have serious consequences for him. Although that is the second most important, we still have statements and other important data Tuesday coming out, so keep an eye on the Forex market definitely. But let's move to Wednesday. And here is our first one. The US ADP Non-Farm Employment Change is a monthly report released by the ADP Research Institute, which provides an estimate of a number of jobs added or lost in the private non-farm sector in the United States in the previous month. The report is based on data from around 400,000 American businesses that employ approximately 23 million workers. The US ADP Non-Farm Employment Change is important for investors and traders because it can give an early indication of the state of the US labor market and the overall economy. The report is released 2 days before the widely followed monthly US non-farm payrolls report and can sometimes provide a signal of what to expect from that report. As this week NFP report is due on Friday, this data can have a significant impact on the value of the US dollar, and therefore it will be watched with great interest by all Forex market lovers. Investors and traders can use the US ADP non-farm employment change as a leading indicator of the health of the US labor market and to look for possible changes in monetary policy by the US Federal Reserve. Since June 2021, the data has been producing declining values, indicating that fewer and fewer new jobs are being created in the United States, which is alarming. This fully supports my earlier findings on why companies are expected to report declining revenue forecast figures, especially at the beginning of 2023. We are already at a very low level, but I would expect a spike in emotions from so-called sudden reacting traders if the value falls between 220k and zero. However, values exceeding these levels in either direction could trigger more significant and possibly sustained movements, not only in the DXY, but also in the stock market. If that wouldn't be enough, after Tuesday, here is another one. Wednesday is shaping up to be a chaotic day as we have significant Canadian data releases, followed by a second speech from Jeremy Powell this week. On the Discord server, we've been talked about a lot what this could mean for every market sector, so we will be following this event closely on the server. But here is another star. The US JOLTS Job Openings Report is a monthly release from the Bureau of Labor Statistics, so BLS, that provides information on the number of jobs opening and the pace of hiring in the United States economy. It is an important indicator of labor market conditions and can provide insight into the overall state of the economy. I closely follow the JOLTS report because it has a strong impact on the DXY. The report provides insight into the strength of the labor market and likelihood of the future interest rate increases by the Fed. With the last 3 reports showing an increase to 11 million job openings, it provided some relief to the Fed as the CPI data was slightly decreasing. However, we are now seeing signs of possible inflation increase. And if we were to also see an increase in wages, it dramatically increases the chance of a higher CPI. So compared to the last 4 months, the situation is shifting and any deviation from the expected outcome of the report can have a sensitive impact on traders. As we know, stable and long-lasting volume is a valuable thing on the charts as it provides a basis for a trader to trade in a confident direction. This is exactly what I will be looking for after the data release, of course, along with the meaning of the data itself. However, it is possible that there may be sudden movements in all directions at the time of the data release, so I personally avoid trading during the time and wait for things to settle down a bit, and after a couple of minutes or even a couple of hours, I can start work. But let's move to Thursday, which is going to be a fairly quiet day. Last week I shared all the important information regarding the US jobless claims. So if you want to stay updated on this topic, which is strongly recommended considering how significant it will be sure refer back to my previous writings or videos. In the meantime, I'm still observing and waiting until I see the spikes in the data. At that point, everyone's attention will be on the DXY. And then let's start the day which everybody waiting for, but technically nobody is waiting for. We start in a real slaughter Friday with the British GDP data. Needless to say, it can have a significant impact on the British pound, so it could be an incredibly good trading day starting in the morning. In January, the Canadian economy created a total of 150,000 new jobs, the largest growth since February of the previous year. This is much higher than the expected figure of 15,000. Most of the new jobs were for the age group between 25 and 54, where 100,000 new jobs were created, evenly distributed between women and men. The 55 and older age group also experienced growth with 43,000 new jobs, while the number of jobs for those aged 15 to 24 barely changed. The largest job growth was observed in Ontario, Quebec, and Alberta, where growth meant 63,000, 47,000 and 21,000 jobs respectively. However, in Newfoundland and Labrador, 2,300 jobs were lost. Several industries also showed growth in employment, with the biggest increase in wholesale and retail, that's 59,000 jobs, healthcare and social assistance, 40,000 jobs, and the education sector, 18,000 jobs. However, 17,000 jobs were lost in the transportation and warehousing industry, which is a warning signal of the supply chain. Both private and public sector employees showed an increase in numbers, with 115,000 new jobs created in the private sector and 32,000 in the public sector. All of this data is mostly positive at the moment. However, as a strong growth can easily lead to inflation, it's worth considering the previous and expected CPI data together with the upcoming data if there is an increase. Additionally, when the data is released, the Canadian dollar tends to show volatile movement, so it's important to keep an eye on that chart at 2:30 p.m. And here is when the fun begins, and we have arrived at the usual monthly bloodbath. We are getting three very important pieces of data from the United States, which are released every month of the first Friday. The first one is the average hourly earnings, which I have referred to a lot in the past few weeks due to the possibility of rising CPI. This is the one that can be a real gut punch to the Fed if it also rises, as it can have an extreme inflationary effect. So anything higher than the previous data can put huge pressure on the DXY, but traders mostly react positively to this. At the same time, the non-farm payrolls data is released, which saw a huge jump in January. This is for similar reasons as the previous data, but if it gets out of hand, it is technically bad news for the Fed with the same effect on the DXY. And if possible, the most important data for me this time is the unemployment rate, where if we decrease, it's not a big deal unless the data goes below 2.5%. I don't consider this a realistic possibility, but a sudden increase could present an interesting situation. We might think that this is not such a bad news for the Fed, but the effect it causes can be very bad. So higher unemployment wouldn't necessarily be bad news for the Fed, but it definitely wants to keep it in check if it goes up. So this day can be very, very exciting. And now let's move a little bit of conclusions. First of all, I want to mention quickly that the crypto market is losing momentum and most probably is going to weakening next week a little bit. However, the volume will be there. It really depends everything on DXY. But if the money stays within the crypto market, DXY can just affecting the market a little bit, but we need to make sure that we are watching DXY as a dominant currency over the crypto, of course. And the main macros are JOLTS, Power Speech, and NFP data. At the same time, Forex market, it will be very interesting. If we experience any strength of the DXY or currencies shows weak macro, then we will have a very clear picture about how the DXY strength will be driving all the Forex market and all the Forex indexes. But now let's move a little bit to the stock market because this is an interesting situation. Fun fact, the Chinese PMI soared. What we see here is the Chinese manufacturing PMI, which clearly hits the roof. Therefore, everyone thinks that the Chinese economy is operating at full throttle and putting everything they have into it so they can generate the next 10 years worth of output in just 1 month. The following chart shows the non-manufacturing PMI, which basically produced the same result with the same expectations. However, although the data probably is accurate, it doesn't mean that we don't have to listen to it. In fact, it's quite the opposite for long-term thinkers. Everyone wants to buy Chinese stocks because they're opening up their economy. This may not be a bad idea, not the opening, but the buying, but the market is pricing in a lot more than what is actually happening. While the PMI shows improvement compared to the previous data, industrial performance isn't growing much alongside it. It could be risky to ramp up production as it could lead to severe inflation. And the Chinese government is already taking huge risk because of this. So while they are opening, they are unlikely to let it loose. By the way, the PMI, and this is very important, is made of 3 indicators. P1, which is percentage of responding managers who reported improvement. P2, which is percentage of responding managers who reported no change. And P3, which is the percentage of responding managers who report weakening in the production. The math equation, therefore, calculates the value based on 3 variables, P1, P2, and P3. We multiply P1 by 1, P2 by 0.5, and P3 by 0. Essentially, the equation assigns different weights on the variables, with P1 having the most weight, P2 having a lower weight, and P3 having no weight at all. That's why, if a data is improving, it could improving badly. But that doesn't mean this is an accurate data. Chinese companies that remained open during the lockdown operated on approximately 20%. This has increased to about 25% with the opening now. Since the PMI reports show the state compared to the previous month, the PMI is much better, but the performance measure itself has not changed a lot yet. To illustrate, the blue line shows the measure of the company's operation, which is the realistic value, and the yellow line represents traders and investors who are buying. When there's a super good PMI showing better performance than the previous month, everyone wants to buy because they think the economy is booming, and the stock prices are growing up proportionally more than what would be realistic based on their performance. So stock purchases far exceed their actual value. However, when revenue results are released, everyone will be disappointed and the dump will begin. So again, those who start investing long-term too early without the right experience, which is not investing but gambling, will lose, and then comes the hodl as an excuse. But the traders will be okay with these purchases as long as they sell before the first earnings come out. So it's an easy explanation. How can we do it right? And how can we do it wrong with the Chinese stocks, which is, in my opinion, highly risky field? I hope the information was useful for you. Remember, at the pro level, we analyze every major macro data and draw the appropriate conclusions when they arrive. If you want to join, visit our website, link in the description, and see what the pro level offers you. In the meantime, I would love to hear your thoughts and opinions in the comment section. If you want to stay informed about the next week's data and other useful information, subscribe and turn on all notifications. And if you enjoyed the video, give us a thumbs up so it can reach more people. Until the next video, good luck and see you later.